Must be a checking account. Um, it's something I'm sure that you've seen, heard, and read before. And if you have any questions with regard to that, you can check out the full disclaimer on our website or speak to your broker or financial advisor, and I'm sure they will give you the appropriate guidance. So little, just quickly about me, nothing too in depth. I won't keep you too long on stuff about me. We'll get into the good stuff in just a minute, but just briefly, I've been trading since roughly 1992, and I started an educational firm in 2003. The firm is called thetradingzone.com. And that's where you'll find me most days of the week, working with our traders in our live chat room that we've been running continuously since 2003. So we're one of the older, longer standing companies in the trading education sphere. Maybe not the oldest, but one of the older ones. We have a nice following, certainly not the biggest, but we have a real great membership, great following, active daily chat room, etc. More recently, I started a company called chartpatternTrading.com, and I'll just run you through just very briefly the difference between the trading zone and chart pattern trading, because they kind of appeal to similar but a little bit different traders. Trading levels, we always start with beginner to intermediate, and beginner to advanced for the trading zone. And the reason we always start at the beginner level is, as an educator, I never know when you come to us what existing level of trading knowledge you have. So we always take it upon ourselves to start at the very basics, and it's quite appropriate. And you'd be amazed, sometimes people come to some of our events, chat room, seminars, whatever it is, and they think they've got a really firm grasp on the market, and you're just amazed at some of the stuff they come up with. So we always start with a beginner's approach, and then we walk you through some of the more advanced, uh, intermediate to advanced topics. In terms of trading styles, chart pattern trading is anywhere from long-term investment to swing and day trading. The trading zone, however, is almost exclusively a day trading, or some people call it active scalping. I don't particularly love that term, but we're more active traders. Markets range from anywhere from stocks and ETFs to futures, currencies, and commodities. The trading zone focuses almost exclusively on futures and commodities, whereas chart pattern trading will also touch on stocks, options, and futures. We are an educational company, so both of our products are really loaded with educational materials, video-based, in-depth walkthroughs, again from the beginner stuff to more advanced stuff. We always provide chart templates for anything we're going to show you. Any methodology, system, approach, setup, we're always going to provide our templates for that. Not, as traders, you should all be able to set up your own templates. It's one of the necessary skills, but we found that sometimes it just accelerates the learning curve a little bit to provide those templates for you. At the core of the actual systems themselves, under chart pattern trading, we have an ADX system. That's what I'm going to be talking about today. And for our day traders, our intraday traders, we primarily use Market Profile, which is a tool, a preferred tool of day traders. The real difference between the two companies, I guess, is how active you are and what type of community you want surrounding you. The Trading Zone is a very active daily community. Like I said, I've been running a chat room since 2003. So it's a very vibrant, active community, lots of traders every day. Whereas chart pattern trading is more of a do-it-yourself, hands-off. You don't necessarily want to sit in a chat room all day with other traders. Want to understand the materials and work on them on my own time. So that's primarily the difference. And I load up the pricing right here for our products and membership right at the beginning of the presentation. I know I'm a little bit backwards in my thinking, I guess, and some people do the opposite. They kind of hold a carrot out to you, and at the final 2 minutes of the presentation, they tell you what you can expect. But this way, you have it all up front. So if it's not something you're looking for, but I'm going to actually go through the core of the methodology of chart pattern trading here today. Yeah, so just briefly, so you can see that the pricing, represents the difference of service level between the two products. And we do have a webinar attendee special today for the chart pattern trading course. What I'm going to do here today is I'm actually going to walk you through pretty much, 65 to call it 72% of the core of the system contained in chart pattern trading. So the topic itself is the ADX indicator. It's an indicator that'll prove any trading system or methodology. One of the things I just absolutely love about this particular indicator is that it can be used on its own to build a system around, and that's what we've done at Chart Pattern Trading. It's a standalone system for finding trades, managing them, entries, exits, etc. But if you have something that's already working and that you love, this may just be that extra little, one little extra little edge that can really help you out. And that's what I love about this indicator. It can serve to improve what you're already doing, or it can be a standalone system. So that's what we're going to be talking about here today. Now, one of the things that comes up and I often discuss in these sessions is the following. There's no special software, no special indicators, there's no black box, there's no gray box, there's no complex formulas. Everything I'm going to show you and everything I'm going to walk you through is available on 99% of every charting platform available. I've yet to see a charting platform that does not include the indicators and the configuration I'm going to show you. Now there may be some configuration differences from one platform to another, and of course I can't go through all the different platforms, but I'll show you on a couple of the more widely used platforms from our membership what the system looks like. And it may be a simple thing. Hey, Greg, that's great that this is even included on a free charting platform, but I put extra emphasis behind it, and the reason I do is when I first came to love trading in the markets 2.5 decades ago, I did so primarily, probably like the rest of you, or some of you, because of the lifestyle that it afforded me, and I wanted to, be my own boss and work my own hours and do my own thing. I don't want to have to answer to anybody, and I didn't want to have to show up to work and answer to a boss, etc. And a lot of people choose trading, active trading, for a lot of those same reasons. And then what sometimes happens is they get hooked into a black box indicator, a black box system, or something that doesn't give them full transparency. And inevitably what happens is you give up that independence, the reasons why you became a trader, to really be your own person and do your own thing. And now you find that you are, where your ability to earn is forever tied into somebody else's system, and you can't really extract yourself from it. And when I first, started to put together systems, methodologies, and came across other people's work, that kind of scared me. I said, well, what happens if this guy disappears tomorrow? What does that mean about the career that I'm building? And that's how I still look at it. So if I disappear tomorrow, which hopefully I won't, but if I do, and you've learned this, and you want to use it for your own trades and to improve your system and improve your methodology, or as a standalone methodology, you can. It's independent of me, and that independence as a trader, I think, is critical, and it's something that I always come back to in all of my presentations. And all of the stuff we teach and all of the stuff we do is based on that core principle, which is, once the knowledge is yours, no one can take it from you. You own it. You're going to make it work or you're going to make it fail, but you own it. It's completely yours to do with what you please, and I'm not going to remove your license from it. I'm not going to extract it from you. So one of the things I believe very heavily in, and I guess when you run a company, your beliefs end up getting translated and passed along down the line. So everything, from an absolutely free charting platform to just about every conventional charting platform out there. So question I often get is, why would I simply give away this incredible information? Right? Like I said, I'm going to walk you through a big chunk of the system, and I often get that. Well, why would he do that? And again, my own personal beliefs, and like I said at the beginning, I tend to approach these webinars very differently than a lot of my colleagues who give you 5 or 10% and try to upsell you the rest. I do the opposite. I give you the bulk. I want you to get to know me and decide whether you want to take the trading journey along with me. If you don't, that's fine. We can't be all things to all people. We can't take in every customer in the world. It's not possible. But I believe that trading is really a journey, and it's not an event. I'm going to show you something, and I hope that you're going to learn it quickly, this one indicator, and you're going to see how easy it can be. And hopefully that will say, hey, I like the way Greg approaches the markets. I like the way he approaches systems. I think I'd like to learn more. I think I'd like to inquire about his other products and services. And hopefully we'll take that journey together. Or if you find that in the next 45 minutes you've gathered enough information that you can take the pieces I'm giving you and run with them and make them work, then power to you. That's fine. That's acceptable as well. And the reason I do that, I go back to the fact that at one time I was on the other side of this webinar as a participant, and I attended a lot of webinars, and I had a lot of frustration about people who said they were going to teach me something, but really spent the next 45, 50 minutes selling me something, and it was a little frustrating. And when I found myself on this side, I said I would never do that. So hopefully that is to your benefit. So, like I said before, we always start at the beginning, right? The notion that maybe you've never traded before, maybe you've never seen charts before, and then we'll walk you through some of the more advanced, intermediate, advanced stuff. So at the very, very core of trading and technical analysis, we have these things called indicators. So what is an indicator? Why do we use indicators? To what benefit is it to me as a trader to use an indicator? And the first thing I'm going to throw out there is the fact that there's no magic. Indicators are not magic. They are not these crystal balls that can predict the future. It's not possible. Nobody can predict the future of a market or any future for that matter. It's just not possible. People say, well, I wouldn't use that indicator because it lags. Every indicator lags. Every indicator uses recent price information and then prints a pretty picture on your chart. But it's the information that you're going to then use and how you use it and the decisions you make that indicator either valuable or useless. So what an indicator is a tool in the hands of a trader. Well, we look at a market globally, and we know that markets are made up of individuals, and those individuals, we call them traders. Let's take, for an example, any particular stock in the world. Let's look at Apple, for example, right? So let's say there's, 1 million people trading Apple. I don't know if it's that many, but whatever, trades an awful lot of shares, so possible. There's 1 million people trading Apple. And we know that the volume doesn't change drastically from one day to another. Like it meanders. You'll have high volume days and low volume days. So it stands to reason that if there's 1 million people trading Apple today and there's roughly 1 million people trading Apple tomorrow, it's going to be the same 1 million people. Some of them will have changed. Maybe we'll extract 1% and there'll be a new 1% who will show up. Maybe we'll extract 2 or 3% and a new 2 or 3% will show up. But we're not going to have, whether it's Apple or Intel or crude oil futures, we're not going to have a group of people trading it one day and then an entirely new group of people trading it on the next day. That's just not how markets work. So because we know that markets by and large are made up of the same groups of people, they develop personalities. And that personality, so the personality of a stock, the personality of a market, is nothing more than the aggregate of all the individual personalities of the traders within. So unless you're going to scrap all of the traders and bring in all new ones, we can then extrapolate that and say that realistically the personality of a market continues to exist until we manage to change the majority of the participants. So why is that important? Because as individuals have personalities, and then we see markets have personalities, we tend to react the same way given the same set of circumstances, right? So somebody raises their hand quickly in front of your face and you flinch. You go to block them because you think that you're going to get hit in the face. And they do it again to you 20 seconds later and you react the same way. You know they're not going to hit you, but yet you react the same way. And then 10 minutes later, you probably all have an obnoxious nephew or somebody who's done this to you at a family dinner, right? And 20 minutes later, they run up to you and they pretend to whack you in the face again, and you flinch again because we're just creatures of habit. And markets do the same thing. Given a certain set of circumstances and events, they're going to react the same way because the individuals react the same way. And that's what we call trading patterns. And that's great, right? So we know that given a set of initial conditions, we have a great likelihood of the results being the same, the outcome being the same or vastly similar given the same inputs to the market or the stock. And that's how we're able to draw patterns. So these patterns, these candles are nothing more than graphical representations of reactions to events in the market. But that's very vague. You can't use that as trading information. It's interesting, but it's not very quantifiable. So along the way, over the years, somebody said, well, let's take this interesting information that says or suggests that given initial conditions, the reactions or the outcome are going to be similar, and let's put something quantifiable to it. Let's put some numbers to it. Well, what we do then is we take out what we call our indicator. So our indicator is nothing more than a tool that measures these reactions to a set of conditions. And it doesn't matter which indicator you're using. Some indicators look really groovy and neat, and they really dress up a chart. Others look like crap and you can't really tell what they're doing. To a large extent, a good indicator is one that's visually appealing, so you can understand the patterns that it's showing you. But down at the very core of what this indicator is doing is it's a measurement tool. It's measuring recent price movement in order to better predict future price movements. So it's measuring that initial set of conditions in order to better determine what the likely outcome is going to be. So if you know the likely outcome to a certain pattern is, this happened and 80% of the time the following happened. Well, that's great. Now let's go and find a tool that we can use and visually represent that on our charts. And that's all that an indicator does, whether it's RSI, a MACD, an ADX, a stochastic, whatever you want. They're all doing the same thing, right? They're just trying to scale it down for the traders so we can very quickly and visually interpret the reaction to the initial set of circumstances. But by no means do we believe that any indicator has predictive abilities that is going to tell us what's going to happen next in the market. It measures it, and then our tool, measures it as a tool, and then our job as the trader is to use that information, to use those tools the same way a carpenter uses a hammer and a saw. The house doesn't build itself. The saw and the hammer don't build the house, but in the hands of a skilled carpenter, the house gets framed, the house gets built. So a good indicator is one that's properly configured, and it should have the following components to it. It should be, as I mentioned, graphically appealing. So because there's so many indicators that pretty much do the same thing, and I can throw up some indicators, and I can throw up a stochastic and a CCI and an RSI and make some changes to it, and you wouldn't be able to tell which one you were looking at because they're all using the same information. They just they just spit out the results in a different graphic format. So if one is more easily readable, it's more graphically appealing, it's going to be a better indicator. So it has to be graphically appealing. It has to be easy to read and easy to interpret. If there's a setup, if there's an alert on your indicator, you shouldn't have to pull out a magnifying glass and sit there and interpret it for 20 minutes. It should jump off the screen. It should tell you instantaneously what's going on in the market. Otherwise, it's giving you confusing and contradictory signals, and we don't want that. We want the signals to be obvious and clear. And most importantly, whatever indicator you're using, it should reveal more about the recent price movement. And the reason I say that is I've come across a lot of traders over my last couple of decades doing this who have overloaded their charts with dozens of redundant indicators. And I say to them, is this squiggly line here, is it telling you something more about the recent price movement than the other 19 that you have on your chart? And if the answer isn't categorically yes, then take it off your chart, because you can get all that information from something else. And no, it's only gonna clutter the workspace and have you make mistakes. As we know, mistakes, charts aren't difficult to read. Traders make mistakes. They make mistakes because they overcomplicate. They use indicators that are confusing and difficult to read, or too many of them. So we're going to talk today about an indicator known as the ADX. Anybody familiar with it? Has anybody used it before? Yes, no, perhaps, I think so. All right. Yes, no, okay. So we got a couple of yeses and a couple of nos, a couple more yeses. Okay, we're pretty much right down the center. So the indicator goes by the name ADX, and it stands for Average Directional Movement Indicator. It's also known as the DM indicator, which stands for Directional Movement. And for whatever reason, it goes by a number of different names. And depending on which charting platform you're using, you may find it under Average Directional Index, Average Directional Indicator, DM Index, for whatever reason. I'm not really sure why. It's part of the series of indicators developed by J. Wells Wilder, and the name may or may not be familiar to you, but he was also the developer of the RSI, which is a much more popular, well-known indicator. And again, what I love about it, as I mentioned earlier, it can be used on its own to signal changes in trend, entries, exits, trade management, setups, or it can be used to just improve or enhance something else that you're already using. Now, the ADX has three components to it. The first component, as the name suggests, ADX, stands for Average Directional Index. Now, the term is really misleading because that component of the indicator actually tells us nothing about direction. It only tells us about strength of the move. It tells us whether the move in the market is real or fake, whether it's a sustainable trend or just a little volume blip. But it doesn't actually tell us anything about direction. So I don't like the name, unfortunately. I've put in some requests to have the name changed, but no one's really listening to me. The other two components is the DI plus, and as the name and the color suggests, it measures the bulls, the buyers, right? Any people who are trading in the long direction. And the third and final component is the DI minus, which is the bears or the sellers, and measures the strength or the continuation of those who are selling the market in the downward direction. Today, what we're going to do, because beyond the scope of the 1 hour we have together, is we're just going to be focusing on the ADX component, and this will help you immeasurably in some of the stuff you're using, or to build your own system or use our system around it. So the ADX, or the DX component, is going to be the measure of strength and trend. So, okay, Greg, but then what do I do about direction if I'm only measuring? Well, you can use the DI plus, DI minus if you want. Or you can use a number of any other tools, including just some good old-fashioned, uh, technical analysis and drawing trend lines. Can you have the slides? I'm going to send out a recording tomorrow, Daniel. So I'll give you a link to a recorded version of this, and you can review it at your leisure or your leisure, however you prefer to pronounce it. So conventional ADX. Let's say I pop this out of the box. I have a brand new shiny charting platform, and I go and I load up the ADX indicator. This is what's going to come out of the box. All three components at once. The black line is the ADX, the green line the DI plus, the red line is the DI minus. Now, the first time I ever saw this, I immediately took it off my chart because it looked incredibly confusing. I've only been doing this for about 25 years. Maybe sometime in the next 25 years, my brain will be able to figure out how to use all three components. But I don't believe you can. I believe that I believe it's exponential. You know, one indicator is easy, two indicators is twice as much, but three indicators is 9 times as difficult, right? It's exponentially more difficult every time you add something to your chart, and especially when you overlay them like this. So I originally tossed it aside, not interested, not going to use it. You know, leave me alone, don't bug me about the ADX. But I came across some traders and some friends of mine who were having some great success with it. So being analytical as I am, I decided I've got to dig back in and see, you know, what's going on with this thing. How can I make it work for me? And the answer was to extract or remove some of those variables. It wasn't a very difficult thing. You know, I like to tinker. I'm sure a lot of you do the same on your charts. You tinker and you change stuff. So I changed the configuration because I wanted it to be graphically appealing and easy to read, as I mentioned earlier. What I did is I took just the ADX component, right? That was that black line that you saw earlier, which is the measure of the trend. And I changed it to a bar style, and I put it on its own subpanel. So I'm not looking at it overlaid on anything else. All of a sudden, it looks a little bit more meaningful to me. So I needed to dig a little deeper, but already it's something that is clean, easy to read and interpret. So now I have something at least that I can work with, as opposed to what I showed you before. The next thing I did is I put up these three horizontal thresholds: 10, 20, and 40. And these are important. 10, 20, and 40 are the key to the system I'm going to be sharing with you. right? And these are just overlaid, and you can do this on absolutely any charting platform. They call them horizontal lines or threshold lines or overbought, oversold. I mean, every indicator has the ability to put these threshold lines on it. They're static. They don't move. They're just sitting there at 10, 20, and 40. But those particular levels on this indicator become meaningful. Let me walk you through how to set it up. And I'm just using Sierra Charts. It's one of the charting platforms I used. It's really no difference if you're using eSignal or TradeStation or Sierra Charts or NinjaTrader. It's really not going to make much of a difference. So you're going to look for an indicator called ADX. And again, you may find a number of different versions of it, including, this one is an ADXR, et cetera, directional movement, right? The real difference between the ADX and the directional movement is whether or not all three of those lines are one stacked on top of the other, or if they've extracted them and allow you to install them one at a time. So the other thing you're going to want is those. This is an additional indicator called horizontal lines. Now, sometimes you have to add that indicator called horizontal lines, and sometimes it's just a matter of actually just drawing a line at that level, and you right click on your setting and you say, preserve throughout the different templates depending on what you're using. In this particular instance, you actually just add an indicator called horizontal lines, and then you set it for 10, 20, and 40. So it's called directional movement index. That's the one I like because it allows me to extract the three different components and put them on separate panels. Here's one. Now this is what it is, just brilliant. Here you get the DMI, which is the DMI plus minus, the ADX plus an ADX smoothing factor. So not only are the three lines overly confusing, but what they've done here is they've added a fourth, I think, to make your eyes bleed. I'm not sure why, but don't use it. I want to simplify. I want to reduce and simplify. I don't want to have more lines on my chart. Please, no. I want to have less. So if you come across this one, they're trying to, I don't know, somebody in their infinite wisdom figured out, let's add an additional smoothing factor. It just makes it overly complicated. So ditch that one. So there's your ADX. Set it as a bar, right? If you have the ability to change the setting, you can leave it as a line. And I get that. Well, what's the difference, Greg? Obviously, the data is not going to be any different if you set it as a bar or if you set it as a line. The data is exactly the same. The reason I set it as a bar is most of the time, the indicators below your chart are set as lines. Stochastic is a line, a MACD is a line, an RSI is a line, a CCI is a line. And I wanted it to stand out. I wanted to differentiate it, so I set it as a bar. And that's just a personal preference. For me, it makes it easier to read. And going back to what I said earlier, a lot of times traders take a bad trade because it's not that they didn't have the ability to read a chart, they just misinterpreted it. They say, and then they go afterwards, I didn't read that properly. So anything you can do to make your setups and your charts cleaner and clearer is going to help you. I mean, go back and read your trading journal, which I hope most of you are keeping, and you'll see, how many trades have I taken last year where my failure was solely due to human error, and that human error, can I trace it back to just a misinterpretation that I read, it was there, I didn't read it properly. So if I can fix that by doing something that's so stupid as changing my line style, and it saves me even 2 bad trades a year, well, it's my money, I want to keep it. And then those horizontal lines, I'm just overlaying those horizontal lines right on top of the ADX, and I'm putting them at 10, 20, and 40, because those are the thresholds that I want to measure. If you're using NinjaTrader, same thing. So here's NinjaTrader actually sets it up with the three. Do we have NinjaTrader users in the room? I won't get too deep into it. We usually do. It's pretty popular. No, not too many. Okay. Oh yeah. Okay, we got a couple. Brad, Michael, thanks. So NinjaTrader by default is going to set up all 3 lines, but you only want to see the one, the ADX. And one of the simple tricks, and you can do this on just about any other platform, is the lines that you don't want to see, just set the color to transparent. Just set the color to transparent, or the color equal to the same color as the background. And then you won't see the other lines. It's there, you just won't see them. And then you can focus on the one you want to see. So the ADX displayed as a bar, and they have an additional little indicator called constant lines, right? Horizontal lines, constant lines, same thing, no biggie. 10, 20, and 40 for those thresholds. Clear, easy to read, easy to interpret. Bars, horizontal lines at 10, 20, and 40. Now, for those who maybe aren't active day traders, I'm not an active day trader, Greg. I just like to swing trade. I check my charts at the end of the day. You know, I don't pay for real-time data because I don't need it. That's fine. You can go to freestockcharts.com. It's an online free, as the name suggests, and you can do the exact same thing. You can set your ADX, just put on the ADX indicator. By default, it's going to come up as a line. You just right-click, set it as a bar, and then you manually draw the lines at 10, 20, and 40, and you right-click to say preserve. And that way, anytime you change the symbol on the chart, this is preserved, including the 10, 20, and 40 threshold. Brilliant, simple. I go back to the very first slides. I like simple. I like transparent. You know, I don't want to be tied down to expensive platforms or indicators. So if you are somebody who's just swing trading and, you know, um, here's a zero overhead approach. Okay, so now we've got it set up, right? Simple enough. It's a simple indicator, nothing complicated. Whether you're using one platform or another, you'll be able to walk yourself through it. But what does it tell us? How? Okay, great. We set it up. What are we going to do with it? How am I going to use it? How is it going to help me improve my trading as you promised? Well, these are some of the things it's going to tell you. One, is there a trend? First, there's nothing more important in trading. Gary is saying the only problem with Freestock is that Windows Silverlight presently won't work. Yeah, you can't use it on Chrome anymore. You got to use Internet Explorer. They just changed that like recently, but I believe that there's a workaround. How far gone is the trend? We'll go back. Is there a trend, right? If there's no trend, do you want to take a trade? So that's the first criteria, and that's one of the thresholds is going to tell us that. So if there's no trend, you know, what's my motivation to take a trade? If there is a trend, how far gone is it? Right? Am I nearing its completion, or are we at the beginning of the trend? Am I jumping in really late, or you know, do I have a substantial distance left to go? Or are we in a chop zone? Am I in a no trade zone where this market is likely to go back and forth and get me chopped out, in which case I want to take small incremental profits as opposed to waiting for a big trend to develop, which may or may not. And lastly, will the support or resistance hold or fail? You know, I'm in the trade. We're approaching an important price level. You know, will the support hold or will it fail? That's what everybody wants to know. Do I need to stay in? Do I need to adjust my stops? Or have I expired this move and it's time to get out? Well, I'm going to show you actually a number of different charts, Roy, so not to worry. So again, going back to the important levels, 0 to 10, 10 to 20, 20 to 40, and above 40. So those are your thresholds, 10, 20, and 40. When the ADX indicator is in the 0 to 10 range, there's no trend. The market is trendless, completely trendless, which means there's no volume, there's no price change over the look back period that you're using, however many periods you're using, and I'll address that in a second. When we go from 10 to 20, the market is starting to wake up. We're starting to have some change in price, right? That's basically what we talk about in terms of market movement. Is the price change? If the price isn't changing, you can't take a trade. Price change is what we talk about. We say when we look at a trend. Not that it's moving from left to right horizontally, but we want to see slope in the market, a change in the price. So when we get from 10 to 20, it means that we're starting to transition. Something is happening. It's your heads up alert. Pay attention. Get ready to start looking for your trade, because 20 to 40 is the sweet spot. This is when the market is trending. I'll address that in a second in terms of in the settings. 20 to 40, the market is trending, right? That's where you want to be in the trade. Above 40, the market has now run into exhaustion. The trend is over. That's why these levels are critical. You don't see a bar set. The bar setting itself is a visual tool. I know that MT4 does have a way of doing it. I'm not an MT4 user, but I know that some of our members are. So I couldn't tell you offhand maybe there may be some kind of trick or workaround. Doesn't change the nature of the system if it remains as a line. It's just a visual cue, right? So here we can see, here's the ADX measuring the trend, and this is the sweet spot over here. So pull out a little. So here's your 10 line, here's your 20, and here's your 40. Okay, so we can see in this whole area over here, which corresponds roughly to this area over here, the market's in a no trade zone. It's trendless. Now, I'm not suggesting that there's absolutely no trade you can take in this area, that there wasn't perhaps a little scalp or two. Yeah, there was. But we can see what happens when when the indicator pops above 20 and it gives you the heads up. And then the indicator runs up to 40. And we can see how that corresponds with what we call the sweet spot of the trade, right? Now notice I didn't take the ultimate high of the market, because when we get above 40 and the ADX indicator retreats, it signals the end of the trend. That doesn't mean that you can't have another burst of activity, that you don't have some late comers to the trade. But essentially, when we rally above 40 and then hook back down, so had the ADX continued, 40, 45, 50, even up to 60, which it can go, but it didn't turn back down on itself, the trend is still intact. As soon as it turns back down while above the 40 line, now you know your trend is over, right? So it did that actually a little early, but we can see how it got you into the sweet spot of the trade. As I mentioned earlier, that's the thing with indicators. They can't predict, they can only measure. And if you're measuring something that happened most recently, you need the data. So we need data to actually calculate. We need the price to come back down in order to get that little retreat on the ADX indicator. I often get this following question. I didn't get it today, but I'll answer it even so. But look what happened here, Greg. We dipped below 20, but you stayed in the trade, where the trade was still good. And that's correct. And actually, this is not uncommon at all with a new trend, that you get the signal, the alert, and then it dips down a little bit. However, according to the ADX system, the trend is over when it goes above 40 and hooks back down, or it drops back down below 10, right? So when you're in the 10 to 20s, you have weakness, but you could just be in a consolidation or holding pattern of the trend. On this particular chart, Paul, this is a 4-range chart. So this is an intraday chart, but I'm going to show you some various time frames. Bob is saying it is in TOS. You have to edit the studies in the chart tab to add it. Thank you very much, Bob. Appreciate that. Let's see. Traders helping traders. Maybe somebody has the answer for MT4 as well. Okay, so going back to this example, 0 to 10, we have no trend. 10 to 20, we are transitioning. So when you're coming off the 10, you go up to 20, right? This little area over here tells you that this downtrend is coming to an end. We're about at the end of this cycle. Now we're into a new cycle, and the trend rallies up to 40. ADX crosses above 40. Now you start to look for your exit as soon as you start to lose the strength of the ADX, as soon as it starts to come back down. We move forward here. So no trend, stay out. Below 10, 10 to 20 transition. Now you can also see that what we have here is, in addition to this new trend, we also have an additional pattern here, which is what we call an exhaustion pattern, right? We come back inside the 40 line, and now what we have is a counter trend or an exhaustion play So this move is exhausted because we moved above 40. It got us out over here because we hooked back down. And now we have a reversal or a counter trend as we move back inside 40, and you hold that until you lose the trend down to 10. If you're under 10, you don't really want to be in the market. What under 10 is telling you is there's such little price change that a small amount of volume could come in and move the market in either direction. So there's very, very little predictability when you're under 10. The market is too tenuous. It could really go in either direction. When you're 10 to 20, it's starting to build up some interest in a particular direction. That's giving you the heads up. Let's look at some, all right, so that was the exhaustion pattern I just showed you. Let's look at some other. Trend is complete until the ADX pulls back above 40 or dips below 10. Those are the two exit spots. On average, how long does transition stay in place? Excellent question, Roy. I'm going to show you. I actually have a slide that explains that because it's different in different time frames, but that's actually a very dead-on question and pertinent to this system. So I'm going to show you that. It's in a couple of slides, so don't go away. So what I've done here is I took an intraday chart of the NQ, and I'm just highlighting so you can see, right, the new alert. The point I'm making over here is the following. New alert because we moved above 20. I made a comment on one of the earlier slides and I said, how do we know if the trend is over or if there's any juice left in it? So by definition, we know that the trend starts on that break above 20 and the trend ends when we pull back above 40 or we drop below the 10. So here's the entry, and you run up into this resistance spot. You got a bit of a double top working here, and you've got this resistance. But according to the ADX system, this trend is just pausing. It's not over. How do we know? Because we didn't move above 40, so we didn't go exhausted, and we didn't go below 10, so we didn't go down to a level of complete disinterest. So you can either go below 10 where there's no longer any interest, or you can go above 40 where you have an exhaustion play. We didn't have either of those. So what we had was a mid-range, a mid-trend consolidation pattern, right? And then you can see we popped back above 20. So even had you gotten out, you would have had another signal over here, but there was no reason to get out. We didn't drop below 10 here. We came close. We came down to about 12, 14s. We didn't drop below 10. So that's just a consolidation or a holding pattern. This was exhaustion, right? Here is the entry, and here is the exhaustion. So this is clearly an exhaustion pattern. We're above 40, and we've exhausted the move. There's nothing left in it. Same concept. Crosses 20 to a new trend, rallies to 40, goes exhausted, right? Once we decline when we're above 40. Now, these work in either direction. Like I said, we haven't touched on the directional component of it. That's the second part of understanding the system. But the first part is just understanding where the trend starts and where it ends. So this is same concept. I'm just showing it to you in reverse. The trend, the downward trend, which is still part of this larger move, right? So we had a little bit of a retrace. And here's the new entry on the green arrow down to exhaustion because we're above 40. So here, if you are an active intraday trader, scalper, don't love the word, but for lack of a better term, this is something that you would look at. This is an example of how many triggers you would see in a given day on something like the NQ using a 6 range or 1.5 point chart, right? So there's about 1, 2, 3, 4, 5, 6, 7, 8, 9, about a dozen potential entries. So in terms of, well, how many trades am I going to see in a day if I'm an intraday trader? This is pretty much how many. These are all crosses above 20, right? New micro trends. I call them micro trends because that's what they are. It's not a trend you're going to be in all day. Um, and these would be the corresponding exits to those. Brad is asking, how do I set stops and risk for and risk control? So that is kind of outside the scope of this, because the way I look at setting stops and taking risk is it's contained in our bigger course. I'll just give you a little a peek. What we do is we look at something called the measured move of a market, and we take 50% of that and we set it, and we don't change that based on a given trade. Maybe a little unconventional, but the reason I do that is if I have to stop and recalculate my stops on every trade, I'm going to spend a lot of time and energy doing that. I'm going to make mistakes. So isn't there a way where I can say, if the volatility remains constant, um, isn't there a way I can use the same stop all the time? And yes, there is. So we've developed a system that we call the measured move. We measure how much a market likes to move when it starts to move in either direction. And our stop is 50% of that. So something like crude oil tends to move in 20 tick increments. So the stop is 10 ticks. In other words, if you say, yeah, but I'm a great trader and I can trade crude oil with a 6-tick stop, perhaps, but what you're saying is I'm not listening to the information the market is giving me. Crude oil likes to move in 20 ticks, which means if you're going to have even the smallest retrace, it's going to go, 8, 9 ticks. So you want to make sure your stop is a little bit on the other side of that to keep you in. And there's actually a complete section in our course about how to do that. So you don't want to keep your stops too tight. You don't want to keep them too wide either. So what we do is we do a little exercise for each market, and then we set the stop. And unless you have a large change in volatility of the market, you'll find that you won't have to adjust that very often. So basically what I'm saying is I would rather review my market once a week or every couple of weeks and make a small adjustment to my stop or target if necessary, rather than do it on a trade by trade basis, which distracts me from the fact that I'm actually putting on a trade. I apologize for the ringing. I'll let it just go to voicemail. So moving along. Michael, for shorting, the actual rules are the same because you're not looking at it for direction. So pop above 20, you get short. Crosses above 40, you get out, or retreats once above 40. Okay. Just another example of a little trade. Now, I wanted to show you something. Sorry, I apologize for that. Sorry about that. I want to just show you a here. So here's another question I often get. A lot of options traders in the room, handful perhaps, 2, 3, 4. One of the nice things about the indicator is because we have this no trade zone, what we call the zero trend, it tells us when the market is likely to go nowhere. So if you're a trend trader, it may not tell you anything other than to go to the sidelines. But if you're an options trader, it's giving you incredible information about perhaps taking a non-directional strategy, condors, butterflies, spreads, right? If we know that it's not going anywhere because there's no trend, what a great opportunity. And then when you get the 10 to 20 transition and you know that interest is starting to build in the market, that's when you start adjusting and paying attention and managing your positions. So it's an interesting way to use, um, what some people use as a stay out indicator as a reason to actually take a trade. And when you get to your 20 to 40 trending, when you know the market is going to move in a specific direction with energy, then you can look at putting on your directional strategies, your calls, your straight out calls or puts, or even a, aggressive back spread. So you can actually use the ADX for options trading as well. Hold on one second. Somebody asked a question about, oh, here it is. Okay, I'll go back to the other slide in a second. It was this one. Somebody asked about how long does it take to get a signal, etc. Right? Here's uh, here is a example of a swing trading setup where you got the cross over here, you got your exhaustion over here. So here's your exhaustion play. It happened roughly at $124 all the way down to below 10, and this took about, if I'm not mistaken, because I once counted up the bars, about 23 trading sessions. And that's something that you have to know, because if you're expecting the results to happen in 3 or 4 candles and they don't, and you start to get a little bit anxious, then you're going to say, hey, what happened there? What about a false breakout above 20, below 20? No, Daryl, that's not a reason to get out. 10 is a reason to get out, or exhausted above 40 is a reason to get out. A little crisscross around 20 is actually a consolidation scenario. Let me go back a little bit. Yeah, okay, so that was the all right, so you wanted to keep it simple. I'm going to just do this, and then I'm going to finish off with the settings, because somebody asked about the settings, or how many bars, or the look back period. So one of the things I'm a believer in is keeping it simple, right? So you determine if there's a trend. Remember these numbers, 10, 20, and 40. New trends happen at a cross above 20. Exhaustions happen on a pullback above 40. Below 10, no interest in the market. You're in the no trading zone. Keeping it simple. It's a really simple indicator, and it's simple to add on to anything else you're using. I love this quote. I think you will also. You may recognize this guy. Investors should remember that their scorecard is not computed using Olympic diving methods. The degree of difficulty does not count. So I look at the ADX and I say 10, 20, 40 is not a complicated thing. It's easily transportable to any other system. It's simple. And some of the best traders in the world will agree that simple is often the best way to go. So can it be used for day trading? Yeah. Can it be used for futures trading? Sure. Some of the samples I showed you were on futures trading, stock trading, swing trading. Absolutely. Options, we covered that. This was the chart I just showed you. Now, in terms of the settings,